Welcome to the Riskwiser Zone. I'm your host, Lewis. As we start this new week, there's been quite a bit of volatility in the markets, especially when it comes to precious metals like silver. Now, silver has always been known for its unpredictability, but recent events have really put it in the spotlight. Just last month, silver hit record levels, only to quickly give back those gains. This kind of volatility can be both exciting and intimidating for investors. So, what's behind this roller coaster ride? Well, one major factor seems to be investor confidence in the overall economy and the stock market. When uncertainty rises, many investors turn to safe haven assets like silver. But here's the thing. Even with its recent downturn, silver is still up over 12% to start the year. That's better than the S&P 500, which has only seen gains of around 2%. This raises an interesting question. Could silver continue to rise, possibly even reaching 200 this year? Some analysts think it's possible, given the interest from retail investors and the potential for growing demand for safe haven assets. However, it's also important to remember that silver has been hot in recent months, and a slowdown might be overdue. As with any investment, it's crucial to do your research and consider your own risk tolerance before making any decisions. We've seen some interesting headlines lately, including one from Yahoo Finance asking if silver is headed for 200 this year. While that might seem like a lofty goal, it's not entirely impossible. After all, we've seen some significant price swings in the past few months alone. Of course, as with any investment, there are no guarantees. The iShares Silver Trust, which tracks the price of silver, can be a good way to diversify your portfolio, but you should be comfortable with the volatility that comes with it. As we move forward in this uncertain economic landscape, one thing is clear: precious metals like silver will continue to play a significant role in many investors' portfolios. Whether you're a seasoned investor or just starting out, it's essential to stay informed and adapt to changing market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and investment, where opinions from experts like Jim Cramer can significantly influence market trends. Today, we're looking at a series of stocks that have caught Cramer's attention, ranging from tech giants to fashion icons. First off, let's talk about Apple and its potential for growth, considering the shift in consumer preferences towards more affordable options. Cramer seems optimistic about Apple's ability to adapt and innovate, but it's essential to consider the broader market context and competition from other tech companies. On the other hand, we have Eli Lilly, which Cramer refers to as the great drug company on Earth. With its impressive track record in pharmaceuticals, particularly in the diabetes and obesity markets, Eli Lilly indeed presents a compelling investment case. However, it's crucial for investors to conduct thorough research and consider factors like regulatory environments and pipeline development. Ralph Lauren is another stock that's been making waves, with Cramer praising the CEO's remarkable job in navigating the challenging apparel market. The company's strategy to expand into top cities and take market share is ambitious, but investors should also be aware of the risks associated with consumer spending habits and global economic conditions. Lastly, we touch upon Oracle, a company that has been working to redefine its position in the tech landscape. While Cramer's insights are valuable, it's also important for investors to look at the company's financials, competitive positioning, and growth prospects before making any investment decisions. As we explore these stocks and the opinions surrounding them, remember that investing always carries risk, and it's vital to approach each opportunity with a balanced perspective. Whether you're a seasoned investor or just starting out, staying informed and doing your own research is key to making wise financial decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at some of the recent developments in the world of finance and economics. We've been following the story of Kevin Warsh, a potential candidate to lead the Federal Reserve, and his views on monetary policy. Warsh has been quite vocal about his stance on inflation and interest rates, advocating for a more disciplined approach to central banking. He believes that the Fed should prioritize price stability and scale back discretionary interventions, which could have significant implications for capital markets. Some experts predict that a Warsh-led Fed would mark a decisive pivot towards a more rules-based central bank, with a focus on keeping inflation expectations in check. This could lead to higher long-term interest rates as markets adjust to a world with less intervention from the central bank. However, others argue that Warsh's views may not align with the current economic conditions, and that his approach could lead to tighter monetary policy, potentially slowing down economic growth. Additionally, there are concerns about the potential impact on the yield curve and the allocation of capital in the market. It's also worth noting that Warsh will face significant pressure from the White House to lower interest rates, which could create tension between his commitment to independence and the desires of the administration. As one expert put it, he will have to show a certain amount of independence in order to keep the committee responsive to his preferences. As we consider these developments, it's essential to remember that the Fed's decisions have far-reaching consequences for investors, consumers, and the broader economy. It's crucial to stay informed and adapt to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.